Today is going to be make or break out here for the stock market bulls and the bears. And I'm going to show you guys, and I'm going to share with you guys why Wells Fargo is actually wrong about what they're saying about 1995. We look at the fear and greed index. We are still in extreme fear territory after the rally that we saw in the stock market yesterday. Now the attention this morning is going to all be focused on 8:30 a.m. when that CPI report comes out. So let's start off real quick. Look at some of the indices across the board. We had the Nikkei up 209 points. However, we had the HSI actually down 60 points. We come over, look at the volatility index. We can see right now in pre-market, the VIX is up 31 cents on the session. Last night during London, we saw the VIX gap up. Now, is this only in anticipation of what is going to be coming out at 8:30, or are we going to see the VIX starting to spike up once again? I do want to give you guys a friendly reminder that yesterday the VIX was down 12%, which is more than 10%, which indicates that today or tomorrow is likely going to be a down day in the market. And we'll see if that stat holds true or not. We come over and look at the dollar index, and in pre-market, we see the dollar index rolling over as well. Then we look at crude oil. Crude oil is slightly down this morning, down at roughly 8 cents on the session. Keep in mind, gold is also near all-time highs, and gold looks like it's getting ready to go ahead and take out the swing points and make its march to go ahead and complete the ABC completion at about 25.86. So when we come over and look at this article right here, Wells Fargo strategist says investors may face 1995 rerun once the Fed cuts rates. Well, all right, so for that, we rewind time and go back to 1995. And here's 1995. All the market did was go up. And what they're going on to say in this article is when the Fed cuts rates, we could see a return similar to 1995. However, I'm going to share with you guys why that is different in just a few moments. But first, let's look at this graph right here. And this basically lays out the framework of the sectors, how they performed, 1995, 1 month before the rate cut, and then the next 18 months afterwards. Now, the first month before the rate cut, we see information technologies up 7.9%, materials up 5.7%. Then we look 1 month after. 1 month after, we can see healthcare leading the way at 4.3%, followed by communication services, 3.7%. However, this is where this gets interesting. 3 months later, we see communication services up 15.9%, financials up 16.4%, and healthcare up 17%. Now, if indeed they are going to be right, meaning Wells Fargo about we can have similar returns to what we saw in 1995, then these are going to be some of the sectors that we may want to focus on moving forward. But hold up, we are not done yet. When we come over and we look at the Fed's interest rate versus the price of the S&P 500, notice before the Fed started cutting rates, our interest rates were at 6%. The lowest that the interest rate ever dropped to going back to 1990, going all the way to 1997 was 5.21. So that is only 75 basis points of rate cuts. The problem I have with this is when we look at the Fed watch tool, we can see the market is pricing in way more than just 75 basis points of rate cuts, which really brings me to this graph right here. Every time the Fed has went on an aggressive rate cutting campaign, it has always led to major stock market corrections. Now, if we only do 75 basis points of cuts, and that's all, then yes, I agree. Wells Fargo could be correct, and we could see a period of the market rallying up quite a bit. But when the Fed goes on an aggressive rate cutting campaign, that's a cue. Something is broken in the market. So we want to pay very close attention. Now, when we come over and we look at the diamonds this morning, and you see the diamonds coming right up to the 50% Fibonacci retracement level, and we want to pay attention. Let's go ahead and look at where the moving averages are. You can see we're able to regain the 50 period moving average is in blue. We have the 20 period up here in white. Somewhere in this area would make sense if the market's going to roll over and either produce a higher low or a double bottom pattern situation. We look at the Russell 2000, and we can see the Russell 2000 this week has not been able to fill either of the two gaps from last week. We're right near the 50 period moving average. Now, anywhere between the 20 and 50 period moving average, this is an area where we can start to see that downturn start to form in the market. Then as we jump over and we look at the QQQs, notice the 20 period is below the 50 period moving average. We came down, we bounced off the 200 period moving average over here. This could be an area where we see the market bounce if indeed the market is going to bounce. And there is no guarantee, guys, that the market is simply going to roll over from here. We're just looking for areas where it makes sense if indeed the market does want to roll over. Now, if the Qs start to roll over, some of the areas I want to focus on would be these high volume areas. The first one being about 444.75 and the next one about 440 down to about 438. If we can breach those levels, then it really makes sense that we're probably going to come down and make a double bottom or even maybe a lower low, and then maybe pop back up later on. As we look at the 4-hour chart, we see the NASDAQ was able to fill 2 of the gaps from last week, but when we look left, you can still see that we have other gaps above us that still need to come back and be filled. We look out here on the 1-hour chart and we can see MACD indicator has a good separation of the lines on the way up, showing no signs of weakness. However, when we look at the 30-minute chart, we can see the MACD indicator is trying to kiss together and maybe about to roll over as well. Yesterday, we had quite a large range, and overnight, we had a very tight range, which we'll talk about here in a few moments. But today, I really anticipate a D as in dog shape profile, unless we still start hearing more rhetoric about the Middle East, or if the market has a very negative reaction to the CPI print. Again, I won't be surprised if we probe a little bit higher, probe a little bit lower, and as we look at the volume profile levels, we have value area low coming in about 459.15. The point of control comes in about 461.83, and value area high is going to be about 462.83. Now, I do want you guys to also pay attention today to the minus development areas, 460.86 and somewhere in the ballpark of 458.33. If the market gets down to either of those two areas, watch for possible rejections on the smallest time frame chart. If we do, we could start to bounce back up. Keep in mind, we still have the wide open gap from yesterday. Nothing says we have to fill it today, but if we start violating value area low, well, you know what? I'm going to start looking down here towards gap support at about 455.58, and then all the way down here towards filling the gap at about 451.53. I want to make everybody aware, Apex 7 a massive 80% sale off all their valuation accounts, pass in as little as 1 day, and you can also get a $150K account for only $40. You get a $250K account for only $40, and you get a $300K account for only $40. So if you want to take advantage of this offer, use the link in the description box down below and use the promo code Mike at checkout. Now, as we come over and we look at the futures markets, notice we've had one heck of a move on the way up. We've been able to basically come back and test these untested value area low and the point of control from 2 weeks back. So that I no longer have to worry about that trade. However, has the market gone a little bit too far too fast? I believe we completed an ABC pattern out here yesterday, A to B equals C to D. And you can see, yes, we more than completed that, but we also had another ABC pattern kind of form right over here, which gives us a price target of about 19,312. Then as we jump over and we look at the 30-minute volume profiles, look, this is one of the tightest ranges we've seen over the past 2 weeks, only 70-ish points of range overnight. Now, we do have a point of control below us that we have not taken out at 19,068.25, and it's going to be critical. I want to see where the overnight levels are going to come into play, but before we can do that, we got to see how the CPI data actually comes out. Now, I want to remind you guys, I stream live Monday through Thursday at 8:45 p.m. So if you'd like to join me, make sure you're subscribed and you have the bell notifications turned on for all. As we come over and we look at the SPY real quick, what do we see? Well, SPY not quite filling the second gap from last week. We'll see if today we can come up and fill that gap. We look over here at the moving averages and look, we're right near the 50 and we're just above the 200 and we're just above the 20 period moving average. We're also right near the composite profile, the high volume node, which would make sense if indeed we're going to get a rejection around this area. Now, as we dive down and we look at the 4-hour chart, MACD indicator, good separation of the lines, 45-degree angle on the way up. We were able to clear past this minus development area. Then on the 1-hour chart, MACD indicator still looks firm, but look at yesterday, all right? Every single candle, even the candle from the prior day, the last candle was green. All the candles on the hourly chart yesterday were simply green. We look out here on the 30-minute chart and we can see that large gap from yesterday, but then we look at the volume profile levels and value area high is right here about 542.29. The point of control is about 541.14. Value area low coming at 539.22. So how do I want to handle this? Well, one, we've kind of already been above value area high overnight, or we're right here near it. So if we're trading below it, I want to target the point of control. I want to target value area low. Anything below value area low, I'd want to target this distribution area at about 537.30, and then gap support 526.29. Anything below gap support, I am then looking to hold runners all the way down here towards filling the gap, and we'll see if indeed the S&P can fill the gap today. We come out here and we look at the futures markets. Notice we've come right into the minus development area. This also makes sense where we can see a rejection back down in the market. And you can see we're also just above that structure breakdown point that we've been watching. We're just barely above it. We'll see if it starts to come back down here today. Then we look out here on the 30-minute chart and notice if we zoom this down a little bit, we have an untested point of control up here at 54.72 but we also have a point of control from yesterday at 54.46.50. Now, I do think that, we have a very high probability of taking out the point of control from yesterday, and we'll see if we're able to take out both point of controls. Look at the range last night, only 11.75 points, one of the tightest ranges we've seen in a while. Now, that is problematic if you're not expecting a big move in the market. I'm expecting a D-shaped profile, but given the fact that the range overnight has been so tight, this is nothing more than the market correlating up, getting ready for a boom explosion out of that area. And we'll see, does it, drop to the downside, or do we start rallying right back up? Now you can see we're still trading right below value area high from yesterday at 54.61. So the overnight ranges are going to be very critical in terms of should we be long or short this market. Now I do want to remind everybody we're still in earnings seasons. Today after the bell, we have Cisco coming out reporting earnings. And let's go take a look at the CPI numbers. We see the core CPI month over month came in right in line with expectations, 0.2 versus a forecast of 0.2, but previously 0.1. Doesn't sound like inflation is cooling off. Month over month, 0.2, which was forecasted at 0.2, but previously negative 0.1. That sounds like inflation's back on the rise. But then we look at year over year and it says year over year drop. So how can year over year drop when we actually see it rise? And I don't know, it's a little bit suspicious if you ask me. That's why they call it the CPI. We look at some of the metrics affecting CPI right here. If we look at fuel oil, rose by 0.9. Also, food was another contributing factor. However, what was really taken away from it, if you come over and look at used cars and trucks, down 2.3%. You take that away and watch out, we'd have another hot print in my own personal opinion. So the question is, are we trending on the right path? Now, after the CPI report has come out, we saw the dollar initially knee-jerk down, boom, trying to pop back up, but the dollar is still down for the day. And we'll see if that holds true. We'll see if the dollar continues to firm up during today's session or if the dollar starts to roll back over. We come over here and look at the S&P 500. Look, we were able to take out the point of control above us at 54.72 and a quarter. However, we have not taken out the point of control from yesterday. I still think that is a very likely probability. And that would also, go in line with our thesis that we're going to get a D as in dog shaped profile, probe up a little bit, probe down a little bit, and then just basically jostle back and forth throughout today's session. We come over and look at the NASDAQ. NASDAQ had a big wick on the way down, was able to take out yesterday's point of control, and now it's back up here. We'll see, does the NASDAQ also form a D as in dog shape profile? Now, when we come over and look at the volume profile levels, we have value area high coming at 19,120.00. The point of control will be 19,108.00. Value area low, 19,087.50. So if we zoom this out, notice value area high is right around yesterday's value area high as well. So if we start coming down below either of those two, I would then want to play the point of control value area low from the overnight. Then we can retarget yesterday's point of control. Anything below that for major targets would really be any of these distribution peaks on the NASDAQ, 18,978, maybe 18,959, 18,937, then down here towards 18,895. Now, I'm not convinced that we're going to make it all the way down there, but we're going to have to take it one step at a time. All right. Before we look at lower prices, we must breach below value area high, either the overnight or from yesterday, before we can worry about those lower prices. As we come over and look at the S&P 500, you can see that we have value area high coming in at 5461.50. The point of control will be 5459.00. Value area low will be 5454.50. Now, notice if we compare value area high at 5461.50 compared to yesterday's value area high, it's only one tick apart. So we can essentially say, as long as we're above value area high, then we want to look for higher prices. If we start coming back down, that's when I really want to target the overnight volume profile levels as targets. But I also have one of my runner targets set down here towards the point of control from yesterday at 5446.50. Now, if we do start to break lower, keep in mind, we had very poor market structure on that move up yesterday, and we can see the market quickly make it down towards that value area low from yesterday at 5413. If we pull a Fibonacci retracement from swing low all the way up here to the swing high so far. Now, if we do go higher, we'll have to readjust, but the 50% of that move will be about 5422. So that would be another target we'll want to go ahead and have on our chart if indeed we start getting back below value area high. Now, if you guys want to learn how to spot absorption in the market using two order flow techniques, watch this video right here.